Hey guys, welcome back to the channel McNallie Money, the official home of power mining analysis. In today's episode, Anthony Power and I are joined by John Belizaire, the CEO, and John Tunison, the CFO of Soluna Holdings, to review their Q1 earnings and talk about their outlook for the remainder of the year. We've got a lot of questions to get through. Before we get into it though, take a second, hit the like button guys. Big help to myself and the channel. If you're not already subscribed, McNallie Money, feel free to join and let us know in the comment section below what you thought about Q1 numbers from Soluna and if you're currently holding shares. Now, with that being said, let's get into today's interview. Okay, guys, so away we go. We've got Q1 earnings on deck today from Soluna Holdings. John Belizaire, the CEO, you've been on the channel quite a number of times. You've brought along John Tunison, the CFO, to help with some of the more financial questions. This is going to be a very interesting discussion. We've got a great list from the audience here. But first and foremost, John Tunison, can we get a quick introduction to yourself and how you got into the CFO role at Soluna Holdings?
Sure. Yeah. So I've been with Soluna now just over a year, and my background's a little bit atypical for CFOs. As I was telling the guys here a little bit ago, I started out as a nuclear engineer in the Navy on submarines, and pivoted from there after getting an MBA in finance into basically finance roles. Started in some bigger companies like Shell, and then transitioned into large private equity companies, and then I've been largely in both private equity, venture-backed, and public companies since then, generally speaking, energy and manufacturing related, and with some renewables. So that's kind of what brought me to Soluna, was kind of a convergence of my background and skill set, and really excited about what Soluna does, and that's what drew me in. Was both we're just solving some really important problems for the world right now. Plus, the team is great. John has put together a great team, and enjoy working with them. So that's kind of why I'm here.
That's awesome. So we might see some nuclear Bitcoin mining on the horizon here at some point, eh,
Who
guys?
knows? I'm intrigued. I am. I'm kind of anxiously awaiting smaller scale nuclear.
I think the time frame for nuclear is well in the future. I was at the AIM conference yesterday, and this question came up about nuclear, and you're looking at 10 years time before they can purpose those facilities. And then we're not even talking big nuclear facilities. We're talking sort of like the medium-sized ones.
Hey, well, then we'll save that for another day, maybe 10 years from now. But for today's conversation, you guys, you just came out with Q1 earnings, so feel free to jump in as you see fit here. Can you walk us through some of the highlights, the key numbers, and some of the operational milestones in the period?
Yeah, sure. So, I'm going to talk a little bit from the slide deck that we just released with the 10Q. So I'll start kind of talking from slide 16, 17, and then I'll pivot to some of the numbers slide. But the story in Q1 of this year, as you know, in our quarterly rhythm, we like to look at the prior year. So Q1 of last year to Q1 of this year, the crux of the story is really around revenue and gross profit. And there is a change in that. And so there's really four key drivers that I would call out for why is there a large change quarter or year over year. The first one, and maybe the most obvious one, but I'll go into why it shows up more this quarter in particular, is having happened in between first quarter last year and this quarter. And then since then, obviously the hash price volatility has continued. And so that's had some impacts as well. So I'll go into that in more detail. We made a strategic decision, and I think some of the listeners have questions around this, so I'm interested to go into that in more detail, but about our commercial mix. And we've made a strategic decision to shift some of our contract mix. I'll go into that here. A third driver is we had some planned and some unplanned downtime, and I'll unpack that in more detail as well. And then we started participating last year in what's called the Demand Response Services Program under ERCOT. And there's been variability of that year over year. So let me first talk about the contract model shift. You can do contracts a few different ways when you're hosting. We had done a lot of what you would call volumetric based, where essentially it's a fixed fee plus an adder, and it's derived from the amount of electricity consumed to do the Bitcoin mining. That's in a cross. So if you think about it, electricity price going up or down fully impacts us, doesn't impact our customer's price. Things like Bitcoin hash price going up or down doesn't impact us, it impacts our customers. So there's another model that we have already used in the past, and we've continued to, and we've pivoted a little bit to a higher percentage, and that's the profit share model. So there, it ties us a little bit closer to the customer. It gives us upside and downside depending on whether Bitcoin hash price is going up or down, or electricity is going down or up. But importantly, it doesn't. It introduces an uncapped nature to that. So as, for example, a hash price were to grow into the future, there's potentially more profit for a customer to be shared with us, and we have that upside. Whereas the volumetric model has a theoretical cap. There's a finite amount of electricity that would be used in the mining operation, and therefore our essentially fee is capped. So what we're doing is trying to strike a better balance of that. Now, what it does mean, though, is, and you can kind of see, we've got a kind of a series of charts on our slides. When hash price is low, the profit share model actually can return less revenue to us. But when hash price goes up, it can grow pretty significantly. So, I don't know about you, our crystal ball tells us approximately that we think hash price is going to go up in the future over the long haul. Who knows what it's going to do tomorrow, but over the long duration, we're fans, we're bullish on Bitcoin. So in that scenario, having a higher mix of profit share contracts, we think is going to win in the future. In Q1, it actually cost us a little bit because of that the hash price volatility. So the next one is, why are we talking about halving still? Because when you look at that year over year, first quarter of last year, the hash price was at a relative maximum, and now it's in the first quarter been at a relative minimum. So that difference is pretty significant. The other thing that maybe isn't so obvious is it's the first time we've had a full year over year, 5 quarter in a row comparison of the same 75 megawatts online for Soluna. And so that obviously any variance up or down is amplified by that. The third thing that I'll talk about is our outages. So we had one unplanned outage, that was Project Sophie. Weather came through, dropped some vegetation on the substation, and originally we thought we were facing a multi-month outage. Fortunately, we were able to work with our power producer and supplier to help them find alternate solutions. We were able to, within a week, restore just over 50% capacity, and by helping with the sourcing and identifying locations for equipment, we were able to, together with them, get back up and running to full capacity within 3 weeks. But that did cost us some revenue and gross profit impacts. The other thing is, on an ongoing basis, our model is to constantly evaluate our customers' miners' performance. And this can be a variety of different things. But if we have the opportunity to, with the same customer, support them in upgrading their machines, we obviously will do that. Or if we switch to another customer. And so that's kind of a normal run and maintain maintenance as we operate a hosting model. So we had some of that where we made those kinds of decisions, both of them. We had some customers that were upgrading machines, but as you can imagine, there's a finite amount of time where you're de-racking, shipping the logistics, re-racking, going through the testing, et cetera. And so, we had a fairly significant volume of that during the first quarter, which also impacted us. The last one was a minor outage at Dorothy, as we had to go through the final steps of the interconnection of Project Dorothy 2, the expansion. And so we had to, curtail and shut down and disconnect Dorothy 1 in order to make those final connections. And so that had impacts. So when you stack it all up, when you look at it on a revenue basis, we were down for all of those drivers. The same impacts carried down to our gross profit, except for the contract mix shift. So one key thing about the profit share model versus the volumetric is the actual revenue comes down because we're not essentially including the electricity cost in that revenue. but it also doesn't show up in the cost of revenue. So on a gross profit basis, it's neutral. So we had revenues that ended up at about 6 million, and gross profit that ended up a little over 1 million at 1.1. On an EBITDA basis, I think it's important to note that we have been and continue to grow our EBITDA, or decline in our EBITDA loss. So we've gone since Q3 of last year, where we had a EBITDA loss of 3.5 million. We've actually improved that to 2.5 in Q4 and 1.6 in Q1. And this is really, if you get into the details, and we've got some bridging and stuff in our slide deck, this is the performance of the core business improving over time. And we're excited about that and what that means for the future. And this is only going to accelerate as we, for example, bring Dorothy 2 online, and eventually Kati. You're going to see these EBITDA figures continue to grow. It also reflects the strategic pivot and decision that we made on the HPE contract to terminate that earlier this year. And you're not going to see, negative earnings impacts related to that anymore. And so, we think the EBITDA trend is a good story. So I think that generally sums up the financial performance of the first quarter.
In terms of that, going back to that first point with hosting, and obviously we take account of, the halving last year, the difficulty has probably been like close to another halving effectively. And so that's been a challenge for most of the miners. And, as at the end of Q1, only one miner was able to produce Bitcoin at a profit. So that's a real challenge for the mining industry if they're going to carry on going forward, Bitcoin mining. And we've already seen, 3 or 4 of the big miners saying they're not raising any more hash rate in Bitcoin mining. It's just not a viable proposition for them. There's more opportunities in the co-location HPC coasting contract. But that's I'm just trying to understand. So with your previous hosting clients, they had a fixed energy cost. And did you have a PPA, or were you using the market rate of energy against that?
Yeah, I'm happy to take that one, John. And thanks for joining, John. I think this is good. You get to hit all of Anthony's questions.
Yeah.
I have somebody to balance off of Anthony in these calls, so thanks for joining.
There you go.
It's a good question, Anthony. So we our fixed cost projects, the way they work, because we're behind the meter, our costs floats right with the nodal price at that location. And we use the Maestro OS to sort of manage the uptime and where we're sourcing energy from at any given time to optimize the blended or average rate for the cost over the year. And so we take on the energy risk in those fixed cost contracts, and we enjoy the fact that we have a healthy margin between those two. But if there's some sort of gas price spike, which we're starting to see some floating up of that lately with liquid natural gas being sold around the world, because of the Russia and Ukraine conflict. So that is something we were becoming a bit concerned about, because as these deals get bigger, we get more of that exposure, and if Bitcoin is compressing, that could be an issue. So we were watching that closely. By pivoting around these different contract structures and at least blending more of that sharing of cost or sharing of risk in the model, that we feel helps our model work a bit better. So moving to shared and profit sharing at some of our facilities that were pure 100% fixed cost gives us some of that blending. It also creates a partnership between us and the customer, and so we feel that is a bit better. Customers are taking the risk on power at our locations, where perhaps they would take it less so at other locations, because our power cost is so robust, right? If you look at our behind the meter system, it grants us access to a swelling pipeline of power, so we're constantly producing more access to power. Our power costs are consistently competitive, so they're better than any price on the market these days. For Bitcoin, we're below $35 per megawatt hour. For AI, we're projecting somewhere around 40 and below. And so co-locating with these renewable assets, it creates a real strategic benefit. And our partnerships and customers are beginning to see that, and they're saying, "Hey, we can take that float on the cost because it's so compelling, right?"
Yeah.
And then they trade that for a partnership on the Bitcoin side, so we can both enjoy the growth of Bitcoin over time. And so we think the blending of those two things makes sense.
So now it looks, the model now is that the power cost is a pass-through cost to the customer, and
Correct.
you have which is obviously from my stance as a management accountant, that's the obvious route to have de-risk everything, because
Exactly.
we've even seen some like one of the biggest miners out there have significant problems with the host company who
That's
had
right.
rights to this power contract for like 10 years. And,
Right.
when power spiked a few years ago, and it really spiked, it causes a lot
Right.
of problems for a company. You can't get out of these contracts as easy as you think.
Yeah.
And I mean, when we look at that type of a model, you're only looking at the power cost as the actual cost against the revenue, really. The rest of that is it. I'm assuming that it's the percentage of profit share, whereas you as a company, when you're looking at your own self-mining, you've got all your own internal costs to take away after the energy cost. But to
Right.
a retail investor, or even in your case, public miners who are hosting at your place, there, it's just that it's just the elements of the energy, and then share the benefits, well, the Bitcoin price as well. So it looks like a real good model for those people that want to get into the space. And even
Exactly.
yesterday at the conference, people come up to me and they must think I'm a Bitcoin miner, because obviously I've got Bitcoin mining but they were saying, "Can we put miners with you?" And I'm like, "I don't have any facilities." And I gave them said, "Soluna here, and
You
come."
just you sent them our way. That's
I
probably
said,
why we
yeah.
got
So
sent
I
down.
pass
Thank
on.
you.
I always pass on the information that I have. I do have, obviously access to contacts, and I will, forward them to the relevant people to try and do it. But people come up to me thinking, they constantly think I've got some sort of big facility somewhere with loads of space for their machines. I've got a room about 15 square meters, which is an office, and that's it.
Hey, John,
Get it on the record. Hey, Anthony, there's one more point I want to make. Also, Bryce, is that in the profit share model, there's a huge benefit to the customer as well, because when Bitcoin, let's say, is at its low or during a winter, they actually can stay on longer in our structure because they have access to the raw power price, right, without margin added to it. So they can enjoy a longer uptime than others will, who have these higher fixed costs on the power side that don't fluctuate, right? And so there's an advantage both ways. So the downside, they're protected, and then we both enjoy the upside.
Yeah.
that's great. Hey, now you made reference to your competitive power rates there. I think you mentioned around 3.5 cents per kilowatt hour for the Bitcoin mining blended. For people who are maybe less familiar with the story, you operate both behind the meter and obviously have access to front of the meter stuff, just like the regular group of Bitcoin miners. Can you talk about this strategy, why it's been successful? We're now starting to see some of the larger scale miners, Marathon, BitDeer, start to come into this type of thinking as well. And do you expect these rates to improve, decline, stay flat? What's kind of your projection for the remainder of the year here, John?
Well, our strategy around power cost is project specific. So we select the sites, the partners, the power generation resources specifically because in that area of the grid, we see a challenge for the power partner, but we also see an opportunity for ourselves for getting access to a raw resource that will power the data centers in our business. Right now, in some of our locations, both in the front of the meter and behind the meter, as I alluded to earlier, we're seeing a rise to some extent in the gas prices that are part of the cost of that are used to create the pricing for the power. And that we think has a lot to do with the amount of drilling and gas that's being available, some of the LNG prices related to sales of gas abroad. And so we manage that using Maestro. We'll shift the source of energy away from the grid to manage the price closer to those levels. So we've been able to sort of maintain those levels. So we'll see a pretty healthy maintenance of those levels. If there's a rise, it'll be very slight, but we still enjoy a very healthy margin below the average cost of energy for all miners in the country. And so even if there's a rise in our power, it's still so much lower than what the average cost is, that miners are better suited to place their assets with us. And so when you look at our projections, that's still looking pretty good.
Yeah, we see some of the miners put their power costs on their monthly operational updates associated with Bitcoin mining, and we've seen a sort of a trend down, and that came across again at the conference yesterday, that miners are seeing a sort of like certainly over the next few quarters, maybe a more favourable energy rates as things start to improve globally.
That's right.
Just while we got John, and we're talking about the finances side, obviously for me as an accountant, balance sheet strength is obviously something to look at. And I know on one of our previous podcasts, John, we talked about ways that you were improving the balance sheet going forward. Can John, CFO John, can you give us an update of what you've done over the last sort of like 5-6 months, and what's still to do going forward to get that balance sheet improved, which obviously then helps you again go into the capital markets and get more potential capital funding to grow even further and quicker.
Sure. Yeah. No, happy to do that. And thanks I like that. CFO John, that's a good way. Which we've experimented with various ways to
differentiate.
But I like that. CFO John, CEO John, that works. A few things, right? So first of all, there's the capital stack and the work that we've done. I think we've talked a little bit about that in the past, but just to reiterate, this is kind of the story of my journey over the last years. When I came in, we had some convertible loan notes. We had a fairly strong preferred B series. We have our preferred A. And what it meant was just complexity. Whenever we needed to go raise financing, there were just a lot of different parties that we had to navigate through, various consent and participation rights and repricings and things like that. It just made things complicated. I think it really made things complicated for our shareholders as well to evaluate kind of what the forward view on shares and valuation stuff would look like. So we've been working hard to simplify that. We're not completely there yet, but what we have achieved is the convertible loan notes are fully converted out. There's really nothing left associated with those. In the process of securing our SEPA facility, which is part of the plan going forward, we were able to restructure the preferred B in a lot of favorable ways. Essentially, it creates a pathway for the holder to eventually convert out. And I think that's in a positive way. So, I think that gives some predictability and a pathway, which is important. And then, we have secured the SEPA, which we used. We have not used all of the capacity on it, clearly, but it's a tool. Think of it as a tool in our tool belt to manage our balance sheet and our liquidity. The other thing that we've done recently is we filed a shelf, and we've also activated an ATM. And so we've used that. And what we're trying to do is put various tools in the tool belt that are simpler, don't have a lot of features that are hard to understand for our investors, and try to clarify the messaging around what are we needing money for. And so there's in a very simplest form, right? There's cash flow for the company to continue to develop projects and get them to the point where they're shovel ready. And then there's cash to actually own increasing percentages and shares of those projects. What we've demonstrated very clearly is these projects are very valuable. I mean, you can look at our financials and see how Dorothy 1A, 1B, Sophie are performing. You'll see it soon enough in Dorothy 2, et cetera. These are valuable projects. They return a lot of cash, relatively efficient use of cash up front, and return good investment multiples and things like that. So owning a higher percentage of those is definitely part of the strategy going forward, and is part of the way that we build the balance sheet. So in the interim, we're using some of these shorter term tools to get ourselves to the point where we're, cash sustaining. That'll, take until, let's say, Dorothy 2 is more or less fully energized, and we'll at that point be in the process of commissioning the first phase of CODI. And that's the point at which, any kind of financing that we're doing after that is really about owning more of our projects and moving our pipeline, faster and bigger. And as we pursue, both the Bitcoin side of that, but also, the AI and HPC side of it, which, we're already working. We're well down the path of working on that. We've talked a little bit about CODI as, the first project with an AI data center component and stuff. So at the moment, one way that you can look at our, financial health and pictures, looking at our cash balance, and in particular, unrestricted cash balance. So we restrict some of the cash. We've got customer deposits, some things associated with our PPAs, and there's other buckets of cash we can't actually use for our own purposes. But if you look at the unrestricted cash, that's kind of what I can use as CFO to pay the bills and make investments and things like that. And that balance continues to improve. So we grew that to 9.2 million, which was a $1.4 million increase from the end of the year. And we continue to work on doing that. And like I said, in the short run, we have an ATM, we have a SEPA that we can use as needed. And of course, we're always looking for the best mix of other financing options, again, to get us bridge through to that point of cash sustainment, and then to enable us to own higher percentages of the project. Overall, it's a good story.
Yeah, thanks. It's not the only metric people should be looking at, but the current ratio, your current assets versus your current liabilities. At the moment, your liabilities are a little bit higher than your current assets, but you just indicated the revenues coming through from projects.
That's right.
Are you happy with the way projects will plan out this year to meet those liability requirements? Because they're over, it's obviously a 12-month period, the current liabilities.
Yeah. So, one tangible example of that is we closed financing with Galaxy, for example. That is one, you should take a few things from that. One, Galaxy is a credible, experienced financing partner. They do these kinds of financings, and it's sort of a validation of the creditworthiness of Project Sophie. And it's a way for us to do some recapitalization and pull some of that cash out, eventually lowering, our cost of capital. And so you could imagine we're looking at those kinds of opportunities. But what it also does is it increases our liabilities in the short run. But we do it very carefully, modeling out what we think the cash flows of the projects will support. And to your point, knowing that we are on track with Dorothy 2, and we're getting close to, stand by for announcements on CODI and things like that. But, our ability to actually plan, execute, close the financing, and then build these projects, more or less on budget and on time is very strong. And we're the rate at which we're bringing the projects online, and the fact that Dorothy 2 is tangibly delivering. It's being constructed, commissioned, on schedule, on budget, and no indications that won't be done. And that's a key part of driving our cash to where it needs to be. And I had talked about the potential for leverage on our projects because they demonstrate the strong financial performance.
Most definitely. And as you mentioned there, Galaxy, really a feather in your guys' cap. Now, you mentioned the pipeline or power portfolio here, John. We always see that nice slide with all of the different projects you guys have, the status of those, and ultimately the outcome of where the revenue will be generated. Can you give us an update on that pipeline? In terms of megawatts, where do you guys expect to be by year end operational here?
So we have Dorothy 2 is our main focus project-wise for ramping that and bringing that online. We are planning to get, by the time Dorothy is up, around 123 megawatts would be our full operational capacity, which is almost double where we've been for the last couple of years, from 75 to the 123. Depending on when we break ground on CODI, which is our next shovel-ready project, I'm pretty excited about that. If we get CODI started this year, it'll be the first time we have two projects under construction at the same time. And so that's showing you some scaling potential for the company. We do expect to begin to ramp that site this year. So, perhaps we'd be north of 123 when we land, I can't speak to the exact number yet, but that's what we're shooting for. We would wrap the construction of D2 and some partial ramping of Kati by the end of the year, if not, early next year, being north of that 123 number. In terms of projects, so we've got our operating fleet, D1, Sophie, our next growth of operations, D2, and then we have Kati, Rosa, Hetty, these big, fairly robust projects. Kati, of course, is shovel ready, so we're going to start ramping that one. And then we have, several hundred megawatts beyond that. We announced 220 megawatts. I think I was doing some work. If you look at our pipeline conversion right now, it's building some considerable momentum, almost sort of unstoppable momentum. We've added 220 so far of new projects under development, Hetty and Ellen. Rosa, that puts us at 407 megawatts of projects in development. And I was doing some back of the envelope, I think, the other day. I think that's somewhere around 26 exahash potential capacity if we'd use it all for Bitcoin in the next 24 months. And if you look at if you add, so that's just the development phase, so 407. But if you add the operating plus D2 ramping, that's close to 700 megawatts of capacity. That's 45 exahash. And I looked at the power mining analysis. That puts us in the same class as some of the biggest miners in the world in terms of capacity. And so it's a pretty exciting time for us because we're now, seeing our vision and strategy come to fruition. It was hard in the early days to convert some of these projects because it's such a new thing, how we do behind the meter, how we structure these deals with partners. The PPA providers or the generation plant owners didn't have as much trust in this model, right? Because there weren't a lot of proof points. Now we have Dorothy, we have Sophie, we have examples of these projects being built in the Soluna world. Great execution. These power plants are making money again, right? The problem they had, we've solved it. And so in the power industry, what I found is that it's a very large industry, but it's a very small community. So word gets out. They're like, "How is that project with Soluna going at Briscoe?" And it's like, "It's going fantastic. We're making so much money. In fact, we're doubling the size. They're doubling the size of the data center this year." So people are getting on the bandwagon. EDF is the first partner we've signed that we're doing this with, and we're signing more. The two projects that we just signed are with new partners, and there's more to come. And so what you should see is more development activities on those projects. And over the next couple of years, you'll start to see more shovel-ready assets come online as our capital allows us to go faster.
In terms of, you've mentioned there that potential products come online. I'm assuming you have an element of flexibility built into some of these projects because we've had two CEOs in the last 5 days on the channel effectively say that the years of Bitcoin mining are not that far away from, and so they're moving, both of those companies moving very much into HPC co-location contracts because the predictability, the cost of capital, the EBITDA ratios that are given to HPC compared to Bitcoin mining, even now, we still go to investment banks and it's a challenging environment to get them to sort of like really give a view on Bitcoin mining, whereas they're happy to talk all day long about HPC. Where do you guys see from yourselves, because you've got a slightly different model from most of the big miners, where do you see Bitcoin mining over this sort of like next 3, 4, 5 years?
Yeah, so I think your question is an apt question. The question is, where does the Bitcoin mining industry go from here? as a number of the companies are transitioning more and more to AI, or there's a mix in their asset base merging there. The demand for energy and AI isn't going down. It's continuing to go up. We've given some thought to that here at Soluna as well. What's important to understand is that we are a two-sided solution provider. On the one side, we are solving a problem for the renewable energy industry, which ultimately drives, it's a catalytic driver for the growth of that industry. And so we build these projects behind the meter. That's our mission, to help solve that challenge of wasted energy. So we build these projects. They have to come up fast to start returning revenue to help these projects, and then ultimately provide a wholesome solution. We need as big a project as possible. So what we've decided to do is focus on designing all of our projects to be a mix, a blend of the Bitcoin hosting, which allows us to ramp that up in a 6 to 12 month, time frame. We can start solving the problem for the renewable energy provider. We have a flexible load back there, which allows us to solve a problem for the grid. And then we combine that with a AI project or an HPC project that is solving a problem for the other side. So we're providing hosting on the Bitcoin side, and we'll provide leasing space and opportunity for those players. And the nice thing is the grid becomes less concerned about a all-encompassing consumer behind the meter that affects their growing concerns around reliability, and this recent deal with AWS taking power plants off of the grid, like that's freaking them out. With our model, we're actually designing it very consciously to add load, add flexible load, and this new form of HPC related load, which gives them confidence in the business model for the power plant owner, right? Because we have a blend in revenue diversity. We have a fast ramp so we can start solving their problem. And then as a company, we have multiple ways in which we can monetize these projects. Not every project is going to be ideal for HPC. There's location, connectivity, environmental concerns to think. And so what that gives us is every project has a viable commercialization option. And some projects will have multiple viable commercialization options, which gives us an incredible growth path as a company. Now, coming back to mining, look, mining is still a global industry. Bitcoin is still a very powerful digital asset. It still needs proof of work to keep it safe. So now mining is not going away in our view. We continue to see it as a vital part of our business, as I just mentioned. And as it relates to the design of our data centers and the design of our projects, that blended approach we feel is the right blueprint for our company.
I think that's a really good answer, and because you shouldn't really, I think that the people take these in isolation, and if you're just saying we are a Bitcoin miner at this site here, it is a problem for all miners. I mean, even if you've got energy at 3.5 cents kilowatt hour, in April 2028, that becomes 7. It doubles. Right. And we're not taking account of what the difficulty between now and then is going to happen to that. So again, to production, but by having the ability to utilize power as and when required for two services, and you're making the best use of energy when it's low to use it for your mining, and obviously balance the load, and then get the full value from HPC, which isn't at the moment as energy, and I say that at the moment, as energy reliant in terms of price, that Bitcoin mining absolutely is. I mean, the sensitivities are alarming, and we hear a 3.5 cents, and that's a good rate. That's in that top quartile of probably the public miners there. I think most of the miners would love a 3.5 cents kilowatt hour rate. Going above 5 cents, and it's not that far away, it becomes a challenge if you haven't got the other thing that goes hand in hand with Bitcoin mining is the fleet efficiency. You need to have handle on both of those two things to sort of drive it. So that's a really good response there, and I'm glad that you guys have picked up on that, because I don't think that's been picked up throughout the conversations we've had all together. But it's certainly something that one of the miners said yesterday, and it sort of resonated with me. And you've mentioned something very much along the same lines of what they've done. And from that perspective, it makes it sound like, there's still a place for Bitcoin mining, and there needs to be, because without the blockchain being audited 24/7, who's going to do that piece of work?
That's
That's right.
exactly it.
Exactly.
Now, you also mentioned the word blueprint in that answer, John, and I agree that was a great answer. I saw in the press release you came out with your second facility patent as well. So this is another way, I guess, you guys have kind of differentiated yourself. I remember last year, Anthony, we were looking at those schematics. You and I thought they were AI generated. They still look quite impressive, and we've got some great pictures there. And looking forward to seeing those in person actually in November. But besides the point, I wanted to see, are you guys planning to eventually license these designs out, or is this more so just to protect your own intellectual property and designs within Soluna?
Yeah, so you must be referring to our second utility patent we were awarded. It basically broadens the scope of our modular data center patent, which focuses on the layout of the MDCs, the thermal design, and the efficiency of those units. For us, patents are both value drivers and protection tools, essentially. Myself and Dip I started my career at Intel. He started at Lockheed Martin, where patent portfolios are a very powerful strategic asset for a company. It affords us the ability to be confident that we can develop unique and proprietary technologies, protect that technology, and then by building that patent portfolio, it becomes an asset that can be a strategic value driver for the business, right? Having those unique capabilities are helpful. They're also tools for helping us develop different commercialization strategies. We don't have any near-term designs for licensing the technology, but in some of the joint venture discussions we've had with potential partners on the Bitcoin side and HPC side, there's interest in working with us even as a let's say a proprietary partner to build out some of these facilities, because some miners are saying, hey, we're not really good at building data centers. You guys are, right? And maybe we want to have you do some of that for us. And we've seen your designs. And some of that has happened because customers are coming to our facilities because they have to review them before they sign a hosting agreement or something like that. And they show up, you guys are going to see it when you come visit. And they're like, I've never seen anything like this. This is a completely different design. I've seen a lot of mining facilities, and this is top notch. And they see how we approach it, the design. We've had some, pretty sizable infrastructure and strategy developers, sustainability financiers come to our sites, and the response is the same. When Galaxy went to visit Sophie, they were blown away. There's like, this is real infrastructure. So we have consciously tried to invest in the design and technology as something that's a long-term asset for the company. So our data centers are true long-term assets and infrastructure that we invest in. And patenting the design and investing in that capability is a proof point that that's something that's important to us.
Just switching to sort of the HPC conversation again, and obviously a lot of the miners, in fact, all bar maybe one or two of the public miners, are now focusing some of their power direction towards HPC, that predictability, the cost of capital that we already talked about. We've also heard about the gap in power required to utilize AI activity in the US at the moment. We know what's being used at the moment. We know what we sort of hear what the potential requirement is. It's a massive gap. How are you guys preparing to sort of like move into that space in terms of, how can you show a client the capability of Soluna in delivering the type of facility that they would need in a sort of like co-location type sort of contract arrangement?
Good question. So one of the challenges I think our brethren in the industry will have in the HPC space is not just making power available, which, it just so happens like the crypto space has a lot of power because we built up those assets over many years. And we've now found a alternate commercialization option for that power. And so you're seeing a lot of that conversion make sense. And that's the right thing to do to, drive value for shareholders. The challenge, however, in executing on that is not easy. You now have to show a hyperscale or fairly large neocloud company that you know how to build these types of facilities, you know how to operate them, and you know how to meet their requirements in the design of that facility. And one of the things we realize as a company is on the power side, we have built an incredible execution capability. We can leapfrog the speed with which we can make power available, which makes RFS dates, that's the technical term for when will the data center be available, come in considerably. I mean, we can bring them in 3 years or more because of avoiding these long queues. But what we can't do is walk in with the Soluna. I like to say walk into an Amazon or Microsoft with a Soluna t-shirt and say, we know how to do HPC. We can build you a massive, gigawatt facility. Instead, what we're purposefully doing is partnering with leading data center operators and infrastructure funds to do joint ventures in our assets where they bring that expertise. So they bring the design expertise, they bring the supply chain, they bring the customer demand pipeline, which is super important, right? You better have customers ready. And then they bring the operational expertise, and we've been in discussions with some of the best in the business. And the goal is to create this new model. What we're doing hasn't been done before. Like this, we have to convince them you should do this behind the meter. We have to convince them that there's a capital structure where we can participate in that capital stack. Given us being a small company, but our project capability, our pipeline and power is so compelling that these folks are sitting down with us to do that. I mean, there was one meeting where it took them a while, like, okay, so this is behind the meter. How am I going to get all the power that I need? And, after a few cycles of that drilling in, one of them, said, and I quote, like, I now understand the beauty of the Soluna model. Mm-hmm. And now, we can turn that into some sort of partnership. And so the goal is to have that t-shirt walk into the hyperscale, into the neo clouds, and be the face, and then we're essentially the infrastructure platform that new business that can be built on. So it'll be a think of it as a three-way partnership. Soluna, there's a capital provider, and then there's a data center HPC developer that joins that three-way partnership to bring the expertise that we don't have.
And in terms of that partnership, I mean, when you have discussions with potential clients,
Yes.
Is it a case of you're as a group of, partners going to those meetings? Because the last thing you need to do is a question comes out and you go, I'll come back to you on that one there because I need to
Exactly. So it's more like that's right. The way I envision it is that developer that's bringing that real expertise and access is walking in the door, and I'm walking behind them and writing writing down as much as I can so I can learn as much as I can. So in the future we have the ability to walk in that room. So we're being very purposeful in mitigating the risks with entering the space by partnering, and we hope that will be a successful model on one project, and then we can replicate that across our fleet.
And in terms of the sites that in your strategy going forward that you've allocated as potential HPC AI sites there, how detailed have the studies been done on those sites to determine they meet all the criteria?
So Kadi, for example, we've done all the studies, so that's fully mature in that respect, and so we found access to. We know there's access to power. We've looked at environmental concerns, and there are a lot that you have to consider. For example, endangered species. Believe it or not, it kind of reminds me when we started in the power space, and you had to look for bats and stuff like that. Otherwise, you can't build turbines. So in our case in Kadi, we had to look for owls. pygmy owls, which are very cute, by the way. And I wish we found one or two. We can make them pets and stuff, but we didn't. So that's good. And you need access to water, road access, all of that kind of stuff. So and connectivity. And it turns out that Kati has lots of different routes for connectivity, great routes to connectivity into Latin America for HPC providers that are looking to provide access to that market without placing facilities in that market. So we're close enough to do that. There's lots of different insights we found through this feasibility analysis that we do. And that analysis is something we'll do at all of our projects. So we now added that as a swim lane, if you will, for every one of our projects where we evaluate that feasibility. And then we check it red, yellow, green. Some, like I said, some will be good, some won't. And then we'll focus on the ones that are green as the mixed Bitcoin versus HPC. And then the ones that don't, we'll focus on it purely Bitcoin hosting. That's our strategy.
We're throwing out, John, backup power is another critical one.
Oh, yes.
You're looking at AI and HPC, you have sources of gas and things. And so like Kati has passed with flying colors there as well.
Oh, excellent point, John. You're quite right. In terms of locality to sort of city, how is Kati situated there?
So Kati's in the southeastern part of Texas. So it's further away from some of your big metros like Dallas, Austin, that sort of thing, but close enough from a digital hops perspective. So if you wanted to build a smaller inferencing location, that's the other thing. Some of our projects tend to be on 150 to 200 megawatt range. So if we did half Bitcoin, half AI, you're talking about sort of 50 to 80 megawatts IT load. Right. And so that's not going to be your giant training facilities that are in the 400s to a gigawatt of size, but inferencing is becoming the next focus, right? If you look at Microsoft's, a lot of the headlines where Microsoft's pullback is maybe HPC is overbuilt and, AI. What happened is they started to realize that they've made a lot of progress on training. These models are very powerful now. What they need to do to drive revenue is to start refocusing their energy on inferencing, deploying the models, using them in environments, and they realize we need more capacity on the inferencing side. And some of the big neo clouds, as they're seeing customers come in and asking them for inferencing platforms, it lends itself to a distributed network of inferencing locations that are in that range, sort of 50 to 100 megawatts, as close to metros. And that, if you can plug that into the network, gives you a growing capacity, if you will, for driving some of this AI growth in the enterprise and going forward. That's where we see ourselves, right? As a company, to differentiate and to be successful, you've got to have a niche, right? You want to be a big fish in a small pond. So we're not going to be everything to everybody. We're going to be the company that focuses on these distributed platforms that can address these new growing needs in HPC and AI.
No, thanks, John. It's really good.
The other thing I would throw in is, geographically, we've got a lot of positive feedback about the location. And Kati is actually what locally is known as the Rio Grande Valley. And so although there's not a San Antonio, Houston, Dallas right next door, there's a number of medium-sized cities, McAllen, Brownsville, Harlingen. So the population is actually pretty strong there. And so that's good for availability of workforce. It's also a nice tidy corridor, potentially with a lot of power distribution going through that area, and the proximity to Latin America are all strong positive favorable factors there.
I'm assuming then, you're saying that, John, potentially this obviously brings more interest to those smaller cities in the area, having the ability, having a data center. I mean, you talk about, Kati and sort of like, maybe 80 megawatts. I mean, I've visited one of the largest data centers in the world in Norway. That was 150 megawatts. That's the, so when you're saying 80, it is still a big data center. Yes, there will be bigger data centers in the future, but at the moment, they're not all built. So that Facebook one in Norway in Sweden it looks massive, but actually it's 150 megawatts, and that's the biggest in Europe.
The other thing you can look at is within a relatively small radius, we're working on multiple projects. Not all of them have been announced or are ready to be announced yet, but you can also look at getting a concentration because lo and behold, wind farm developers tend to put wind farms where the wind blows, and that happens to cluster them in relative proximity. And so, same with solar developers and things like that. So there's also those potentials when you start to look at scaling up HPC and AI, and that's very attractive to the hyperscalers as well. So imagine a few different 80 megawatt data center projects within a 10-mile radius or something like that. That starts to look like a campus. You can share some of the assets, some of the distribution. And there's a lot of synergies there as well.
I'm assuming, because you mentioned solar, you mentioned wind power there, obviously both reliant on the elements to drive that energy. I'm assuming the grid is always the backup, though, isn't it? Being on the main grid as well.
Yeah. So we have
with also local backup power that would be part of the project.
Yeah,
right. Because if you have to come off the grid for emergency
one thing these HPC clients will want is they'll want uptime with in terms of power. You can't really afford to be down too often. Maybe not as critical on training, but certainly if with inference, I think they'll want certainly to have that level of power there. But by having some of it as renewables, you can probably get a great majority of that through that, and then remaining through like you say, through the grid.
Hey, great discussion today, you guys. I know we're a few minutes over. During the course of this discussion, Bitcoin has now surpassed a new all-time high. So we're up over 109,425. So if you guys enjoyed the conversation, that's awesome. If you're enjoying the new all-time high, that's even better. I wanted to give you an opportunity to close out. Thank you both for the time today. Great to get the financial lens on everything here as well. And there's so much going on with this company. I feel always we could run these interviews for 2 or 3 hours and not run out of discussion topics, but we'll save it for another day. Give you guys the mic to close out, and thank you again for the opportunity.
Well, thanks for having us, gentlemen. It's always a pleasure to be on this program, this show. The questions are always great, and the discussions are great. I agree. I could keep going. I think in closing, I'd say that Soluna is off to a great start in 2025. I feel like our vision is coming together. Our capitalization architecture is now in our control, so we can start to reshape that to help drive our growth. We are converting our pipeline at an incredible rate, so we'll see more conversions this year. Dorothy 2 is ramping up, and you'll start to see more customer wins there as we fill the facility. We are working our best to get a Kati groundbreaking on the calendar this year, so stay tuned for that. There'll be some new capital formation activities and announcements, and again, we're working hard on these HPC AI JVs. There's just so much going on. I feel like, as a team, we are so busy, but for the best, most possible reasons. I know some of our shareholders might think we're going slowly and we should be going faster. And trust me, we're going as fast as we can. We've added 222 megawatts just in this quarter into our pipeline. I think clearly our momentum is building, and so there's a lot to be thankful for as a CEO with this team and our new CFO joining our team as well. We're just so focused on our business. We have real clarity on what that looks like in the next 12 to 24 months, and we're just focusing on execution at this point. So thank you for everyone who has been supportive of our company and continues to invest in it, and we appreciate your support.
You bet. We're all here cheering you on. You guys are also down in Vegas for the Bitcoin conference next week. So if anyone here is attending, make sure you stop in, say hi to John and the team. If you have any additional questions for Soluna that we didn't touch on today, leave them in the comment section. We'll try and get those answered for you. Hit the like button. Feel free to subscribe. We'll see you back here later.